Stock started off the week with a little bit of a pullback here, obviously due to geopolitical risk with a drone bombing in Saudi Arabia's oil fields over the weekend. That caused a spike in crude oil, as we all know, and a little bit of a pullback in equities. What does that mean? It's with the technical picture, we were kind of expecting that. How big was this pullback in the wake of that, and what should we expect? How much more should we expect? I'm going to break all that down in our technical and our market outlook today. What's driving today's move in reaction to what happened last week, and what we need to see drive the next leg higher as we start this intermediate run. So that's the topic for today. Our trade idea is an individual name that's in a kind of a beaten up stock. There's been a lot of sectors that have been beaten up, that have rallied. This one really hasn't, but it looks like it might with today's move in this particular name. So let's go ahead and get started. Today is Monday, September the 16th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started, as we always do with the Market Forecast Indicator. Again, as we talked about on Friday, we most likely at some point in time this week get the near-term line dropping below 50. Well, it took all of one day for that to happen. It happened today. The intermediate posture is still strongly bullish. Market sentiment's falling here at 63.5, 63 2/3. But it looks, as you can see, like it's close to turning higher. And that's about as bullish of a combination as you can get when you have strong bullish posture up here in the upper reversal zone, rising moving average, as this barely turned green, mind you, and then a market sentiment line is rising too. And that's already above 50. So, a little bit of a shock to the system over the weekend with this news out of Saudi Arabia, but considering the range here, 11.5 points, a little bit of a gap. We closed at 307, and today's high was so about a 10-point gap there. So you add on 21-point range with a 33-point average range. Considering the fact that we had such a tremendous a geopolitical event over the weekend, that's about as much as the market really cared about it. It was negative. Obviously, you can see crude oil over here on the left, very strong. We'll talk about that more in here in just a second. But the reality is it's just a little bit of a breather, as we expected. And again, that breather could come down to this blue line, which is the old retracement zone area. Excuse me. The black lines here is the current near-term rally, the one that we're retracing right now. And in one day, we're retracing this long near-term rally that lasted about 12 days. That's 7 to 12 days is a typical time frame for these near-term line runs to last. Eventually, I expect another one to develop here sometime this week. We might get another day or two of selling here before we get going on this new near-term rally. We'll get rid of this here before we get going. So keep that in mind. We're not out of the woods yet on this pullback. And even if I were to throw on the 23% line on the near-term run, you can see 29.76 is where we'd be looking for there, and that's still about another 25 points 25 points away. Excuse me. So but even if we pop down, even if we pop all the way down to 29.50, we'd still be bullish, right? It would still just be a short-term pullback. It might bring the momentum line down, but it's already down. In fact, this combination of a strong bullish posture with the intermediate line above 80 and an oversold momentum line. See, it took, here we had a few days of selling, and this is kind of the pullback we were expecting, right? I compared, if I were to go back to the full year, I compared the pullback I expect now to this one on Friday and to this one here. So this one didn't get the near-term line below, but this one did, and it took a couple of days, and are we going to get a day like this? That certainly didn't end the bullish run. We just continued higher after that. If we did get another day like that to 29.50, that would not be a problem whatsoever. We'd get a lot of people working up, and we'd get some really good buying opportunities for some directional trades, because remember, despite this near-term volatility we might get, as early as tomorrow, including today, if you can even call it volatility today. At least volatility in terms of the range and the volume. The VIX did jump up. It didn't get back above 15, but it did jump up there. But even if we do get this near-term volatility right now, we still expect a 1 to 3 month intermediate run. Most likely, I'm guessing towards the end of the year, and I wouldn't expect that intermediate run to end before the end of the year. So we could very well be bullish heading into what is seasonally a very bullish time of year. Now, it wasn't last year because we had a breakdown in October into the end of the year. And whether or not that's the case, that wasn't the seasonal pattern. The seasonal pattern is to expect what we're expecting now with this run starting at the beginning of October, at the end of September. If you recall, we were at the end of an intermediate run, right back over here. So over here, by the time we got to October, we had already had a multi-month intermediate rally to get to that point. So now you recall the difference between now, which, here's where we're at now, mid-September. The difference between where we're at now and then is we had already been bullish up to that point, and we're just starting to be bullish at this point. So that's the main difference if you're trying to compare with recency bias. The core Q4 of this coming year to what we saw last year, which the year before that, you can see Q4 was very bullish. And that is the typical pattern. Let's take a quick look at the Russell 2000. Remember, it's been outperforming to catch up, and you can see in the short term, it was actually up today. So in the short term, it's staying strong. So it's got the bullish pattern. The market sentiment line's rising. It's not above 50 yet, but it's rising. So it's looking, the Russell 2000 is looking really good. And the fact that the near term line's still above 50, now it dipped here where the S&P didn't. So it hasn't been. It's been above 50 for longer, for not as long, as the S&P had. But because of this, that's why I kind of expect we'll probably get another day of selling on the near-term line before, and get the near-term line, at least on the Russell, down here too, before we really get going again. As you can see, so far the near-term peaking here and dropping, we haven't had any kind of declines on the Russell, and that's fine. We want the Russell to outperform. It just kind of needs to be more in sync. And so we'll see if that sinking pattern takes place tomorrow with any kind of more of a broader selling before the new near-term rally starts. Because again, as I anticipate any kind of weakness, it's not that I'm anticipating intermediate weakness at all. I'm actually expecting a nice intermediate run to come out of this, and we're just barely starting it. But it's hard to get started. It's hard to use up all your momentum to go from cluster to strongly bullish in a near-term run, which for the S&P, this was all one big near-term run. It's hard to really get going with that without an exhale. Because if you don't exhale, then your intermediate rally just won't last very long because you can't inhale forever. You just can't inhale forever there. All right, before we look at some other charts here, as always, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that red subscribe button that pops out. There's also one down below the video if you're on the YouTube watch page. Also, while you're down there, hit the thumbs up icon. That tells me two things. Number one, you like the video, you got something out of it. And number two, that you want us to do the video again tomorrow. So it's our only way of getting feedback. We don't do surveys or anything like that, and we look at those numbers each and every day. So if you like these videos and you want us to do it again, with one click, you can let us know down with that thumbs up. You can do that right now while you're watching. Also, while you're down there, comment. What did you get out of the video today? Let us know. We're always interested to see, what you got out of it, and especially as others come for the first time, why they should check it out as well. Again, join our daily market outlook email list. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe. Very easy way to do that. Follow me on Twitter for more content in between the videos from day to day, as well as you can kind of get a little bit of who we are too. Brandon and myself, if you follow us on Twitter, and then finally join our community that we've created for the Market Outlook on Facebook. Also, I do live Market Outlook trade review videos on the days I do the Market Outlook. We did one today on the market before the market closed at 3:30 Eastern Time. The link to watch those are always here underneath, top right, above the video to the top right, here where it says Market Outlook. There's the calendar for upcoming classes. The dividend growth investing class is one of the classes in our Plus subscription. So if you want to get access to those live trade review videos and this class in particular, one of our most popular classes, then here's a link right above the video here that will get you more information on that subscription plan, as well as you can sign up for the 30-day free trial to watch those as well. Also, we ask that you engage with us on social media. We try to make it really easy for you. The more you engage with us there, the more Twitter and Facebook will put our content at the top of your timeline. They don't always do that for all the people that you follow, so to make sure you get our stuff, just likes and retweets are as simple as it gets to do that. Just hit this little heart. It opens up a new window. You can like today's Market Outlook tweet, and then same thing. Facebook's worse than Twitter is, so they really won't show you our content in your timeline unless you engage with it. So click that image, takes you to your Facebook post. Again, just hit the thumbs up icon or likes or heart, whatever it is over there on Facebook. I can't remember now, but then that will ensure that Facebook knows you want to see our content. And again, it's not just a one-time thing. It's kind of more of a daily thing. The more you do it consistently, the more, again, their algorithms pick up that you want to see our stuff. All right, let's take a look now at the long-term charts, and you can see we got a good bullish candle here this week. It's not, we don't have an upper, we're not above last week's high point yet, so we don't have that upper shadow that you like to see to kind of continue the trend, but you don't have to have that. As you can even see right here, we didn't get a higher high before we continued. As long as we don't get the lower shadow and the smaller body, right? You didn't quite get one of those in this one, but you can kind of see what they look like here and here. Whenever you start these bearish trends, you tend to get these reversal candles. And so we want to avoid something like that right there even. Those are the kind of candles we want to avoid. And obviously, barring a major drop this week, we're not going to get that. So that's the nice thing about Hakenyashi is they take out the ins and outs, the short-term volatility, and they just help you recognize the trend that you're on, which is still obviously, according to these candles, bullish. We're above a 50-day moving average. Well, here, let's take a look at the regular candles. You're above the 50-day moving average. The 50-day moving average is rising. It's above the 200-day moving average, which is also rising, and the gap between the two is increasing. I mean, that's as bullish as the patterns you can get on this chart. You look at the 3 green arrows, and of course, the MACD histogram is falling off, so we're losing some momentum there. Not surprising, because that's what happens. The histogram will come down towards 0. That's kind of the norm for this. The stochastics still reflects buyers are easily in control here, so that's not, we're not anywhere close to even the 1 red arrow, much less the trend changing. If you look at the 2-line versions of this, you can see all we've done so far on the MACD is just come down to the 8-day moving average, which is what we talked about Friday, is what we expected. We expected that would come down towards the 8-day. We might flirt with it. I doubt we'll touch the 17-day, even though that's where that 296 area is, kind of the top of this gap formation. So that might be in play, depending upon if we have that kind of pullback, a bigger candle. Otherwise, if we just kind of get this kind of pullback like we saw previously with the falling MACD, then we'll just stay along the 8, right, and then bounce off of that. So either way, it would not be like I said, if we fell down to 296, that would not be an issue whatsoever, because that's where 38% Fibonacci retracement and the 23% retracement of the bigger intermediate rally. I mean, that's where there's multiple layers of support, as well as the bottom of this gap here, this breakaway gap that we had. So stochastics is below its moving average, but not, the stochastics is also, its average is also very high. And you can see here too, the MACD, this orange line, when it gets up to these really high levels, it stays up there for a while. Even as the histogram drops down to nothing after that initial surge, right, the orange line will still stay up as we trend higher. So that when we get a real significant break of, and even over here, it took a while before we got the significant break of the MACD. And so not expecting that type of pattern yet here. To where we're going to test a 30-day moving average. Most likely we'll stay above it, similar to what we saw over in this area, and again over here in this area, where the blue line came down to the moving average and then held it and bounced off of it, and the orange line stayed up here for a while longer as we continue to trend higher. Let's take a look at the intraday chart, and you can see the pullback here. So there's going to be a layer of support here around 298. So even if we did fall to 296, And if we broke 298, there's the possibility we go a little bit further. We fill in that gap here and get down to 292. So that is a possibility, not out of the realm of possibility at all. Let's watch that 298 level to hold first here, at least early tomorrow, if not by the end of the day tomorrow. And then look for the new bullish near-term run to start from there. So we'll keep our eyes on those levels. Let's look at the volume and the range today. Again, considering we had this big geopolitical event here. Here, let's pull up SPY. The range was 1.7 points, no gap, right? So well, we filled in the gap. 1.7 points, and then the volume here at 58 million. So again, we had this big geopolitical event, and it's not that one, sorry, this one. Big geopolitical event, and our range was well here down there at the low point, and the volume was at 58 million, which is way down below the average too. And again, you can see, have we like had too much of an intermediate run to not be able to take advantage of this anymore? You can see that the ATR still hasn't fallen below 1%, and that's usually when the intermediate run has taken hold, and now we just grind higher, because the grind can last a long time. There's little volatility, and you can even see on the volatility chart, we bounced up here, we held 15. So the longer we stay below 15, the longer we stay below 90%, the longer we just grind higher. It's slow and it's boring, and there might be some stocks that make bigger moves because of earnings or something like that, but for the most part, we just kind of continue to grind our way to the upside for however many months we have on this intermediate run that's starting. All right, so before we look at what's driving today's price action and our trade idea of the day, let's just quickly pause and summarize the technical outlook. So the intermediate posture is bullish, remains bullish. We're still in the nascent stages of this intermediate run. In fact, the first near-term rally of that run has just basically ended, and now it's pulling back. And we expected that this week. It happened all in one day, and even then, the stock market's reaction to this geopolitical risk over the weekend was pretty darn negligible. So this kind of shows, again, how bullish we are. And remember, this first rally off the near-term run was your oversold sectors, and that's generally true as well. As you get your really oversold areas that lead the initial bounce. Now you don't want those losers to continue to lead. You want your leadership, your typical risk appetite oriented areas of the market to lead now, and that would be your more cyclical, discretionary technology, communication, the cyclical areas of healthcare and communication services. You want them to start taking off and pulling up some of these other areas like industrials and materials and financials along with them. So we'll see if that ends up playing out this week. So let's see if this near-term pullback lasts maybe another day or two before, by the end of the week, we should get that bullish near-term run started again. So what do you think? Do you agree with that assessment? Technical assessment? Do you disagree? As always, there's a link popping out right there. Click on that. It opens up a poll, and then hit either vote either agree or disagree. If you hit disagree, comment in the comment section below what you're seeing that prompted you to click that. Of course, everybody's got their opinion, but if you got something that's driving that opinion, share that down below with the rest of our market scholars community. All right, now let's talk about what's driving the price action here. Let's go to our asset class comparison. You can see the big jump. Now, if you recall, obviously nobody knew this event was coming last week. And if you recall, last week we talked about the discrepancy we saw with crude oil being very weak and going into the end of the week, basically from Tuesday morning's Tuesday morning where it peaked here, and then it dropped all the rest of the week, along with bond prices, which is not typical. Usually they move in opposite directions, whereas small cap stocks and large cap stocks and international stocks all rallied into the end of the week. So that's not a typical behavior. And so while nobody expected this spike, again, the environment was set up for a spike to occur because one of two things was going to happen. Either crude oil was going to rebound and catch back up to where these other risk asset classes were trading last week, or they were going to pull down. And we weren't expecting them to pull down that much. We were expecting a near-term pullback, but not that much of one. So in other words, crude oil was oversold according to its relationships with other risk asset classes, and that oversold condition obviously reversed itself today. As you can see, we jumped up here all the way up above $60 a barrel, clearing the reversal zone. In fact, for the first time, you can see we had this intermediate rally, right? And we pulled back, and we've been flirting with the top end, this 23% Fibonacci retracement zone. And that's when you clear that is when you get the new intermediate rally starting, and we've cleared that, right? So this is the first move, like the S&P has cleared it on its own. And we talked about how the Russell and the Russell had to catch up with a really big week last week to catch up to the S&P. Crude oil in one day here made a real big catch-up move from a technical perspective. Obviously, again, it's not like whoever ordered the drones thought, oh, crude oil is really lagging behind what it should be because of how far equities. So let's do this and make sure crude oil catches up. And that's obviously not the case. But the reality is, crude oil rallied, but stocks didn't fall too much. And bonds, we didn't have that big of a reaction as some of these others. So this kind of shows, again, how oversold it was. Even though it looked flat, it was relative to other asset classes in the same space that it typically has a pretty strong correlation with. It was oversold, and it's caught up that quickly. Let's take a look at how bond yields responded, and you can see a little bit of a Harami pattern on the yields. So we've had this big rally, and it's very typical after you've had a big move to get to a certain level that we kind of hit. In fact, we hit some resistance on the 23 on the retracement zone. If this is the big drop, this big market sentiment drop, which essentially we were looking for this market sentiment rally now to the upside. You would expect it to be the case if stocks are still in the midst of their own market sentiment rally. Well, which is interesting that stocks have been able to have a decent market sentiment rally this whole year, despite yields not participating, right? If you were to do a comparison chart here of the S&P 500, and then you can see, this is when the market sentiment rally started for stocks, and we did have the same pullback in yields as we did in equities, especially from this October level. They both dropped down pretty sharply, but as they both bounced, equities kept on going while yields continued their market sentiment decline. And they both fell here, they both fell there, they both fell here, but equities have been able to get going again. Whereas, in fact, the S&P 500 is well up above this, this December high point, and it's well up above this October high point. Yields obviously aren't even close to its same October high point, way over here on the right. So it's interesting that the stocks have been able to stay relatively bullish. I mean, it's very minimal positive gains, but without bonds selling, with bonds being bought up so much as well, that's not a common relationship either. So again, one of these has to catch up to the other, and you expect yields to start to catch up to some degree if we're going to continue to have an intermediate run into the end of the year. And right now, if this is the market sentiment low point, then, and you can see, from a weekly perspective, we have multiple clusters here. From a monthly perspective, we had a monthly cluster at the end of August. It's not very common that we get those, but you can see we do get those, and they tend to suggest that we are very, very low and that we're finishing the month at a really significant low. So we expect that yields will make their run back to the upside once it clears this 23 Fibonacci retracement zone. Then it gets up into that area. So look for some softness now because we're hitting it as a resistance before eventually breaking on through it. Finally, let's take a look at the dollar. So the dollar's had, again, the expectation is the dollar will be bullish and very similar environments from an equity in dollar and a valuation standpoint as we saw in the mid-90s. If you see that, we had this big pullback here in the last couple of days, and you think, dollar's another false breakout, and you see, lo and behold, we bounce back up again, and we're maintaining the bullishness back to a dark green line again, and back to a rising moving average. So that line will be green too. So back to the bullish pattern that we see on the dollar, and which again means that if the dollar rallies and equities rally, which can happen, we saw that in the mid to late 90s when we had the quote unquote mid-cycle adjustment. Then usually technology, discretionary stocks, those large mega cap names will continue to lead their way out front. You can see here let's refresh this page to get up-to-date numbers. The odds of not getting a cut here in September have increased all the way up to 1 in 3. So I mean, just a week ago we had a 95% chance of a cut, and a few days before that it was 100%. 0% chance it would stay here. Now that 0% has climbed sharply up to 34%, and that's looking to be it. I mean, even by the end of December, the odds of not getting a cut at all by the end of the year is 9%, but then you only have about a 42% chance. You have a 60, a 60, 42, that would be 42, so 68% chance of getting one cut by December. So what the market's saying is the one cut could be either September or December. It's not clearly going to be September. So that's the interesting development in the futures market. And then you can see the odds of a second cut by the end of the year, has gone from, let's see, what would that be? Let me get my calculator out here. The odds of getting a second cut after one would be, what? Oops. So minus 100, 15.5% odds of getting a second cut. So they're pretty much done. In fact, by next April, you look at the odds of getting a cut, a no cut by then is 3.5%. Here's one more. So here's the one cut, and then the odds of a second cut after that. You're looking at pretty much a coin flips chance that we'd get a third cut, a 46% chance that we would get, a second cut by next April. So 46% chance, which has gone down significantly too. You can see just a week ago, we had the odds of getting two cuts, right? Here's the odds of getting the one cut was 95%, and then the odds of getting the second cut was 75% by next April. That was a week ago. That 75% has dropped all the way down to less than 50, down to 46%. So the market's saying we could get one more cut, and it could be now, this week, or it could be in December, and then that's pretty much it. The market's not really pricing in very high odds at all of any more cuts after that. So things have really drastically changed, and a lot of it's because the economic indicators are looking really positive. I mean, the U.S. is all the way up to almost 20. You don't see here on the graph because it's not updated, but the G10 is all the way up to positive now. It's up to 4, and that hasn't been the case for a long, long time, right? Since 2018, early 2018 was the last time. So the economic picture globally is starting to improve and looking like it's bottoming out here and rolling back to the upside again. All right, so when you look at the sector performance here, and let's take a look at the sector and how they're doing. So let's come up to the sector comparison. And let's just take a look at the last, just today. Let's start off with just today in reaction to what happened here over the weekend. So just give me 1 second to pull this up, and then we'll go to 10-minute chart. So obviously energy stocks, we know why they rallied. And look, you can see here that the previous losers or previous winners, they bounced back. So, and you can see the areas like financials and industrials, they didn't drop too hard. They bounced up the most last week. They didn't give up a lot of those bounce back gains yet. In fact, your consumer stocks were the worst, and they would suffer the most if energy stays up. And the materials, interestingly enough, was our worst performer this morning. It didn't start off that way, but it really dropped sharply by the afternoon and stayed down here. Big time drop in materials. So kind of interesting to see how the impact that this geopolitical event had across the different sectors. Now let's kind of zoom back out to like the last 3 months or so, and again you can see the picture in energy. The energy was so beaten up, and it's got so much room to rally. And of course, industrials, financials, materials were also the biggest losers. Materials didn't hold a lot of its recent gains, but industrials has, financials has a little bit of a drop back. But expect, consumer stocks, we'll see how long that they suffer in reaction to these higher oil prices. But look for tech stocks and communication services to lead the next near-term rally. If they lead the next near-term rally, then we know this intermediate run's on solid footing. You also can have other sectors too. Obviously, industrials and financials you would expect to do well. You wouldn't expect real estate and utilities. They'll probably start lagging. But then the other one that now has to catch up, and it's been lagging the most here, is healthcare. So while energy has kind of taken off, and so has industrials and financials, healthcare was another loser that has stayed a loser. So you're starting to see a little bit of signs there of improvement in some individual names in that sector. One of those names is Cigna. As you can see, Cigna has a new, strong bullish intermediate posture with this little rally it's had up today. In fact, it's moved up so much that you can see its moving average turned higher, and we're above it. So that means we have a green line and dark green shading here on the chart. Market sentiment hasn't turned up yet, but we just barely crossed it with the intermediate line. So you expect the longer it stays strongly bullish, it will rally higher. If you take a look at the 3 green arrow chart for Sigma, obviously you have a renewed 3 green arrows with us getting back up above the moving average here. The MACD is still bullish as it was dropping, and it turned back up higher again. The buyers are in control according to the stochastic indicator. You look at the 2-line versions of that chart, and you can see we're not quite to that last stage of confirmation on this intermediate run that would have pretty much the orange line crossing above 0, which typically occurs in the 8 and the 17 cross. That's not what brings the orange line over, because it's just a moving average of the blue line. But they typically coincide. That's like your last stage of, okay, now we're bullish on this. You can also see too, when you look at the Bollinger Bands here, we are still in the upper half. We came down to the moving average. We came down to the point of control and held it for support and bounced off of that. The point of control signifying a very strong support level here at 160. You look at the DMI, and we do have the bullish pattern of the positive being above 25, the orange, the negative being below 20. We don't have the positive above 30, though. That's when you're like, okay, we're directionally bullish here. But we do have the bullish pattern. So we have, kind of this burgeoning bullish development here on the chart. It's still kind of sideways. It wasn't like extremely oversold. So it's not an opportunity necessarily for a speculative directional trade. But we do know we have some pretty strong support down below us with multiple layers, including that point of control. So what that typically means is we can sell the 160 and buy the 155 call option here. They're relatively widespread, so you have to kind of get, depending upon where you can get filled in here. It might end up getting filled in right around 115. Again, the typical 30% return on risk is around is the $1.16 level. So that's kind of for a $5 wide spread, that's what you're shooting for. So we'll see if that ends up getting filled in early tomorrow here. We didn't quite get filled in by the close today during the Market Outlook live session, depending upon where you had your order. Some may have been filled in there. But now we know, okay, if as long as it stays above support at 160, this trade is worth it. That's what will get our maximum gain on that. It doesn't have to. If it goes up quick and we get half of that gain, we'll take it. But most likely, there's not a good directional pattern yet, and we're not coming off of an extreme low where we're kind of get a V bottom, and we're not really breaking out either. But we do know we're bouncing off some strong support, and as long as we stay above that, no matter how long it takes, till expiration at least, then we can get that full maximum reward here of generally about 30% return on risk. All right, and that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Any registered subscriber, logged in subscriber can participate in the forums, including our free subscribers. So open up if you have any comments or questions about today's video, post them there in our Market Outlook forum. As always, thank you very, very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon down below, and comment on our video. Also follow me on Twitter for more content in between from one video to the next, and join our community at marketscholars.com. as well as the Market Outlook community we've created on Facebook. All right, thanks again, everybody. Have a great evening, and we'll see you all next time.